Hi everyone, this is Pete Birchler of StockMarketAlchemy.com, and I'm coming to you on Wednesday, April 24th. I have a few pieces of information to go over today. We're going to look at some multiple time frame momentum analysis or technical analysis of stocks. We're going to look at the commitment of traders data briefly, and also going to look at the gold market and what to look for or anticipate there in that market, since it's made such a dramatic move recently. Now, this first chart you're looking at here is one I've shown regularly on the blog in past updates. And this is showing the sum of Dow, S&P, and NASDAQ futures contracts, showing the commercial position, so the smart money, so-called smart money position. And what I had mentioned in the last update is that the previous reporting period did not contain data based off of the breakout to new all-time highs in the SP 500. And so this past week's data would tell us to some extent what their reaction was to the breakout to new all-time highs. And then it also included this past Monday, not this week's, but the prior week's Monday, which was a very large down day and took the market back below that all-time high. So it encompassed two kind of pivotal days in the market. And what we saw is that there was a very minimal change in the commercial net position. However, they did increase their net short position. So that means that despite the breakout to new highs, they actually continued to increase their short exposure. So they didn't cover their positions any on the breakout to new highs. So what I would take that to mean as an interpretation is that we probably are very near to seeing this market actually enter into a correction. If they were to actually cover those positions on the breakout, that would be possible information that they will continue to do so. Maybe they're buying into the breakout in stocks, and so they're lessening their short exposure on the breakout. But in any case, my interpretation of this is that we are probably close to seeing this market break down. And in order to get a feel of what to look for to see if that happens, let's go over to a chart of the weekly chart of the S&P 500 first. And this is a stochastics indicator under the weekly chart of the S&P 500, and what I've mentioned in the last couple updates is we want to see this blue %D line move down below this 80 level here prior to possibly having some good confirmation that we may be in the midst of a correction or very near to the market starting to move down. As of today's data, the %D is slightly below that level, so that should be a warning to us that most of this uptrend is probably done. Even if we do see it poke higher, we should probably take that as a signal that the easy money's been made on the upside, and that's especially coupled with this divergence in the stochastics as price moved up. So we have a divergence, then we have the cross back below 80. Those should be indications to warn us of a reversal to the downside. Now, one thing I also mentioned recently, are these dots here on the chart. This is a parabolic stop and reverse type of study, and it's a mechanical system for helping to time trades and to adjust stop losses as a market moves in your favor. And with the move down last week, we saw that the weekly SAR was triggered to the downside. However, immediately this week we're seeing the market move back up. And what I want basically to point out is that's been very common on these weekly time frame signals over the past several years. And I'll just take you through a couple past examples. In this case, this wasn't a great example back in September and October of last year. Once it was triggered, basically the market chopped around for a few days and then moved lower. But back in April of 2012, as soon as it triggered, we saw the market move back up towards and retest the highs prior to breaking down. So a more effective strategy would be to wait for this initial swing low for it to trigger, wait for a multi-day rebound, and then what you want to do is you want to short potentially on a break of that low. So in this case, short on a break of that low, and once it came down and moved below there, moved down for several weeks. So in the what we're looking at here is what we'd want to see a break below last week's low. And if that occurs, then that is probably going to lead to some additional follow-through selling here, at least for a few weeks to the downside. And we saw some similar things happen on these other reversal signals too, as within a week or so after it triggered, we saw a move back up towards the highs. Once it triggered here, move down, move back up towards the highs, even back into the top of the prior bull market. So in October 2007, that bull market topped, it came down, it triggered the SAR, and immediately, basically upon triggering, it put in a couple week rally back up towards the highs before breaking down. Then once it did break down, it did so relatively dramatically at that point. So I think that's what to look for here is to look for a break of that April 18th low. Now let's move into a daily chart here and get a little bit better view of that. So this is actually the NASDAQ composite, and a lot of the indexes look the same. Let's look at the SP 500 here. What happened is on this recent decline off of the April 11th high, the price broke below this April 5th low, creating a minor break of support. Now it's immediately reversed and moved back up, but what this has given us on this daily chart is a series of three swing lows right at this 1540 level, basically 15, maybe 38, 39 level on the S&P 500 cash. So and the market has basically tested that level once, twice, three times and moved higher. If we see price come down and break through that level on a closing basis, that's probably going to be even further chart-based confirmation that that support level has given way, and we should see the market move down and test at a minimum this February low, which would be the next significant chart support around 1485 basically. So multiple indications here that if we do see a break of last week's low, that we could see some follow-through selling to the downside. Now on an hourly time frame, this is an hourly chart of SPY, so the S&P 500 ETF. What we want to look for here is we want to gauge what's happening in the price logic of this market, in that we want to see if this move up off of the April 18th low is able to completely retrace this decline off the all-time high prior to this vertical line here, so prior to Friday, around noon Eastern time. If so, that would clearly indicate the strength is still up in this market. But if we look down here at the MACD, we can see the MACD is relatively overextended, basically almost as extended as it has gotten over the last few months. So it is a bit stretched to the upside, so it would continue to need to power to the upside here over the next couple of days. But if we do see the market start to consolidate below those highs, we could even end up with a situation where we get maybe a divergence pattern here at a lower high compared to the all-time high. So if we do see that, that would be probably the ideal signal or warning signal that this is going to fail to make a new high, and we should anticipate this market moving back down towards these lows, which would probably lead to follow through on the downside. So keep an eye open for that. If this hourly MACD rolls over, or if it rolls over, gets a mild new price high with a lower MACD high, creating the divergence on the indicator, and then if it moves down from that point. So that's what's to look for on the hourly time frame. Now, I do like to watch a 15-minute chart on the indexes too, because in tight trends, a lot of times you don't get these well-developed divergence patterns on the larger time frame. So this is a 15-minute chart of SPY, and you can see at the top of the move into the all-time high here, there was a strong divergence pattern that developed on the 15-minute chart, led to this decline. Then we saw the MACD and momentum trough here on the 16th, and then we saw as it moved lower on the 17th and 18th a divergence type of pattern show up here. Now we're seeing kind of the opposite of that. We're seeing the MACD peak here yesterday on the 23rd, and despite prices kind of chopping sideways and making a higher high than yesterday, the MACD is considerably lower. So what we'd want to see probably is some type of larger scale trend line break and reversal signal. So here is the base trend line of the rally up since the 18th. So if we see that trend line broken, or if we move to let me move to an hourly chart here briefly. So if we move to an hourly chart and we see the hourly SAR, parabolic SAR trigger, those would be some indications that we have a trend line break, we have a significant loss of the upwards momentum here, and we should probably favor the downside or a retest or break back of those lows there. So that is what I'm looking at on these multiple time frames in stocks. Take-home message is this April 18th low needs to hold for the continuing bullish case for stocks. Now, the other thing I wanted to look at here is the gold market because of the profit potential here and the dramatic move that was made over the last couple of weeks. So I discussed this in relative detail in the last update. Is we saw this break of the last couple of years support level in gold at around, if we move to a futures chart, around this 1525-ish, 1527 level in gold, and we saw this dramatic fall through to the downside all the way down to around 1325-ish, and since then we've put in a multi-day rebound up to this point. Now, what I think is happening here, and it's relatively common chart pattern when you see these vertical type moves, is the market does not tend to make its final price low on these extremely vertical type moves. So in an Elliott wave type of outlook, those are often a middle part of a move, like a wave 3 type of move, and you see this tremendous peak momentum. And while most of the price move may be done at that point, you typically see some type of consolidation followed by a break to new extremes in price. But at that point, you're often looking at divergences and non-confirmation type of patterns to show up between price and technical indicators or related stocks. So I think what is happening here is we had this breakdown and this tremendous price move in gold, and that probably led to a significant short positioning, so washed out the longs and probably established a number of shorts in this area here. So what we're probably seeing currently is a short covering rally in gold. So and that would basically lead to a continuation of the downside move. So once we see on a short order time frame chart, once we see this this move up start to weaken and turn back down, we will probably see a continuation of the downwards trend. Now, whether that happens very quickly or whether this is takes a longer consolidation before that happens, we'll have to see. A couple of the typical patterns would be for a rally that looks something like a flattish type of pattern in Elliott wave terms, where we see an up, down, up type of move, and it might not take that long, but something to this effect here, where we see the market consolidate above this major move, and then once we get that type of pattern and we see it break down, then we would be looking for a move down below this low at a minimum. Now, the other option is this is just a very very short directional short covering rally here, and we see the market continue directly down and break to new lows. That's probably a more bearish scenario in the longer term, I would think, as opposed to seeing a stronger consolidation that's going to set up a more powerful potential divergence on a break to new lows. So in order to gauge this, I would suggest moving down to an hourly chart. And what I've done on this chart here is there's kind of a mini flag type of pattern developing. So off of the low on the 15th in gold, we're seeing on an hourly chart prices move up inside relatively parallel channel here. So if we see prices move down below this trend line of this channel, especially if we see a gap below there and some fall through to the downside, we can probably target this low as a minimum as a first profit target, and then have some type of trailing stop methodology in order to allow the market to move down significantly if it does. Stop and reverse, parabolic stop and reverse signal on the hourly chart. So if we move down to this indicator here, we can see that currently the parabolic stop and reverse on GLD ETF is at 136.06. So if price were able to move down by about 1% from these levels on gold, it would trigger that. And a nice thing about that is that we've already had one failed trigger yesterday, and oftentimes it's nice to see a couple fake out or two at a high prior to the trend actually establishing itself. So I would say that this next signal would likely be a more higher quality symbol than this last signal, now that we've had some consolidation at the high. So if we get another break lower, a break of this lower trend line as well, that may lead to a nice parabolic type of move down in gold, and you can simply use the parabolic stop points to adjust the stop loss as price moves in your favor. So that's my take on what is happening there in gold. So that is really what I wanted to cover in this update. If there are any specific questions, let me know, and or either post them on the blog or on YouTube, and I will try and get back to you or provide more information on that. I guess one other thing I will show you here are a couple of charts from sentimenttrader.com. I don't have any affiliation with sentimenttrader.com, but it's a great site, so I'll give them a little plug here since I'm showing the couple of charts here. But the current market sentiment environment in stocks is kind of a unique situation. It's kind of a mixed bag compared to some past market environments. But there are some things that are just so consistent and telling that I want to show a couple things. And these are real money gauges. And what this is showing here is the flow into or out of mutual funds. And mutual funds are more like the classic, individual investors way of accessing the general stock market. And it's very consistent historically that when we see large inflows into mutual funds, that often occurs near market highs, and when we see large outflows in mutual funds, it often occurs near market lows. So what we're seeing currently, as of the last couple of months, is a huge influx of money into mutual funds. So this is probably an indication that this rally is on a long-term basis relatively overextended, and possibly even nearing the type of situation we'd see at a legitimate bull market top. So that's one thing I wanted to show. And then another gauge of pure speculative type of activity is when you start to see a lot of volume or trading activity in the penny stocks. So this chart shows over-the-counter stocks or penny stocks and the dollar volume transacted in them, and we saw this dramatic 1-month jump last month in these penny stock dollar volume. So it's back up near where it was in early 2011 and in spring 2010, when we saw some significant corrections occur in stocks. And this was a very large month-over-month change as well. Now, it is not nearly to the level that it was back near the bull market highs. So by that estimation, maybe we could see significant increase in speculation in these small issues. But in any case, as far as the character of the current bull market from 2009 to present goes, it's showing a very significant uptick in that speculative activity in these kind of small gambling lottery ticket type of stocks there. So those are just some relatively pure contrarian real money data that I think is going to help us confirm that in addition to the commercial traders being heavily net short in the futures market, and then we're seeing this influx of typically dumb money issues into stocks, that with that situation, I do believe that on a long-term basis we are looking at a market that is close to making a significant correction, probably larger than the corrections we've seen over the last year, maybe something more equivalent to what happened in the middle of 2011 and 2010, or possibly even a greater correction than that. So that is my take on the situation there, and what we'll need to do is just again follow some type of objective technical triggers and trade management process in order to try and profit from those moves. So that is all for today. All the best to your trading.